Today we're diving into a fascinating paper titled A Devil's Bargain: When Generating Income Undermines Investment Returns. It explores the potential downsides of chasing high yields, particularly with covered call strategies.
It's a crucial topic, especially for income-seeking investors. The allure of high yields can be strong, but it's essential to understand the trade-offs involved.
Exactly. The paper argues that there's often a negative relationship between yield and total return.
That's right. It's not always a direct correlation. Sometimes reaching for the highest yield can actually hurt your overall investment performance.
So, is it a devil's bargain? Let's unpack that. The paper starts by highlighting the market's, especially retail investors, fascination with income generating strategies, particularly covered calls.
Yes, many investors are drawn to the promise of steady income streams, and covered calls are often marketed as a way to enhance yields.
The core argument revolves around how covered call strategies generate yield. Can you explain the mechanics?
It boils down to selling call options on assets you own. The premium received from selling these options boosts your income. However, the strike price you choose for these options directly impacts your potential returns. Lower strike prices generate higher yields, but also limit your upside potential if the asset price rises.
The paper uses a toy model to illustrate this relationship.
The toy model simplifies the market dynamics but effectively demonstrates the inverse relationship between yield and total return. It shows how targeting higher yields by selling lower strike calls increases your short exposure to the underlying asset, potentially dragging down your overall returns.
The discussion also touches upon the volatility risk premium.
Yes, selling options exposes you to volatility risk. The model shows that while shorting volatility can generate positive returns, it's often not enough to offset the negative impact of increased short equity exposure in high-yield covered call strategies.
The paper then backs up the toy model with historical analysis of S&P 500 index covered call strategies.
The empirical evidence supports the model's findings. Over various periods, higher-yielding covered call strategies tended to underperform lower-yielding ones, especially in recent years.
It seems like there's a potential for misinterpreting the role of covered calls.
Absolutely. Covered calls are not inherently bad. They offer exposure to both equity and volatility risk premia. The problem arises when investors focus solely on income generation without considering the broader implications for their portfolio.
The paper raises a provocative question. Is it even income?
It challenges the conventional understanding of income in the context of covered calls. Selling a call option creates a liability that isn't resolved until the option expires or is bought back. The initial premium received shouldn't be viewed as pure income without considering the potential future costs.
This brings us back to the devil's bargain.
Investors chasing high yields might be spending more than they should based on a flawed understanding of their portfolio's true income potential. This can jeopardize their long-term financial health.
The paper also plays devil's advocate by acknowledging the role of option maturity.
That's right. While the paper primarily focuses on strike price, maturity is another lever. Shorter-dated options can offer higher yields, but they also come with increased risk and potentially higher trading costs.
Taxes add another layer of complexity.
Covered calls can be tax inefficient. Investors might face tax liabilities on premiums received, even if the underlying asset declines in value, leading to an overall loss.
The paper also discusses downside beta.
Covered calls create asymmetric exposure. You're fully exposed to downside risk, but your upside is capped. This asymmetry increases with higher derivative income targets.
So what's the key takeaway for investors?
Focus on a holistic portfolio construction process. Don't let yield be the sole driver of your investment decisions. Understand the trade-offs between yield, risk, and taxes.
That was a great discussion. Thanks for sharing your insights.